Hey, good afternoon, everybody. Tom Stewart here. I'm with Liz Trotter. This is Smart Business Moves.
Hey, y'all.
This is St. Patrick's Day Eve.
Okay, what is up with my window is different now.
What's wrong with your window?
Well, in the past, you remember how I used to tell everybody you had to pick the tab, comments, or chat?
Uh-huh.
I don't have that option anymore. Well, hey, Linda, Denise, one of y'all that's always here, make a comment so I can see where you're going to show up for me.
So you don't have the little bar over on the right that Leslie just said, hey.
Okay, so I see what it is. It's there is just new functionality. Hey, Christiane, love that name. For the record, just love that name.
Do you have your second monitor hooked up yet?
Yeah, I have it hooked up. It's at a different office.
No. So do we really need to do the GoFundMe thing to get you a second monitor?
Okay, the second monitor is it's not the cost. You know how big my monitor is, right? You remember? It's like 42 inches.
Mm-hmm.
I don't have room on my desk for two monitors because I have a cat over here on one side. I have my monitor and I have a plant and my lamp, and that's all.
And you can't get any work done if your cat and your plant isn't there.
Exactly, Tom. Please.
And getting more
relationships and aesthetic. I need both.
And getting more desktop space isn't really an option either.
What for? Why do I need the second? Y'all, are you seeing a lack of engagement from me because I have?
Do you realize how much more productive you could be, how much more effective you could be, how much value you could be bringing to Smart Business Moves and our audience here if you just
if you can convince me, you send me a monitor, Tom. Send me a monitor. I'll hook it up.
You've got a monitor, and you just don't have. You got a plant in the way.
It's true. It's a beautiful plant, though, Tom. You wouldn't want me to get rid of this plant. It's beautiful.
You see, Leslie says you need another monitor.
Oh, Leslie, why you gotta be like that? Leslie, I have no room. You want me to get rid of my plant? It's so pretty.
So Sam's going to be here.
Hey, Sam. Go ahead, Sam.
You want to talk about what we're going to be doing for the rest of the week and the week after and the week after? You want to talk about tomorrow? Let's talk about tomorrow while I pull up our schedule for the next couple of weeks.
Okay. Did you remember if you're going to pull up the schedule, did you remember to switch out my this week and next week?
Of course not, but I can do that.
I reminded you. All right. Linda, you too. Ed too. Linda. Aw, y'all. Okay. Tomorrow we are having a Foundations Alumni Reunion. Yay! I'm so excited about that, actually. And we're going to be celebrating St. Patrick's Day at the same time. So the reason why we're bringing in the Foundations alumni is for two reasons. One is, first, we miss them. We want to chat with them. We want to find out what everybody's been up to. And we just want to hear what's going on with them and see that. But second thing is, we also thought that it would be valuable for you all to be able to hear what is working, where are some of the problems, how are people overcoming, just what, Tom, you don't have to, well,
it's just,
that is a really cute cat. So I see why you had to post that up there.
Yeah.
Yeah.
I didn't even notice the cat. It's all about the monitor. It is a cute cat.
Linda does have really cute cats. She has mascots in her office. So anyway, so that's what we're going to be doing tomorrow. We are going to be talking about what's going well, what's not, where struggles are, what people have figured out, what they're doing really well, what's working, and hoping that sharing that with y'all is going to be insightful and helpful. If you're coming tomorrow, Tom is also going to be practicing for the first time, right, Tom? First time.
Yeah.
Streaming us on Ring Central. Yeah. Robin, yes. I'm with Robin, Tom. Long cable. You send me a cable long enough to go from your office to mine. I'll hook up
a 3,000-mile cable.
Yeah. It's a good idea. That's a good idea, Robin. I like that. Totally forgot what I was going to say. I really love that idea.
We're going to be experimenting with the technology that we want to use to be able to do Zoom calls that we'll be able to stream to, our Facebook pages. So for Smart Business Moves, we're moving in a direction, and tomorrow's the first time that we're trying it. If it works tomorrow, we'll be doing it more frequently with our 5 o'clock Eastern calls, where if you want to, you can join the Zoom meeting and actually be part of the show. Or if you want to just watch us on Facebook or YouTube the way you currently are now, you can do that too and be a spectator. So you can be on the field or you can be in the stands. Is that a good analogy?
Yeah, that's actually really good. So our Liz, you're a ray of sunshine. Thanks, Leslie. See, Tom, I'm a ray of sunshine.
You think how awesome you would be with 2 monitors, though?
I think I would just be distracted. Like, how am I? Oh. All right. So, one of the things that I really love about this idea with Zoom is like that. It would be so awesome to just be able to chat with you guys. So much of the time, it's like Tom and I are chatting together, and then we like reference whatever y'all are talking about versus being able to talk with you. We've known this for a while, but it's not as easy as it seems to just be able to go live and do like a Ring Central call and have all the additional functionality. So luckily we have Tom, who loves tech, and he literally said today, you guys, well, I kind of want to do it the hard way because I like to. Single task. I was just thinking how well Liz single task to accomplish things. I personally would die at least 2 monitors, but doesn't necessarily process the same as everybody. Super achiever. Yay! Thanks, Sam. Sam's on my side. Yay.
Being able to do that with only 1 monitor is amazing. Just think of how awesome you could be with 2.
I'm turning them, Tom. Look,
I've got 4 monitors and I still can't keep up.
I do have 2 monitors in my office at work. I actually have my laptop, and then I do also have 2 monitors, but the 2 monitors is harder unless I'm doing something where I need to go back and forth. Then I will. And actually on this monitor, it's so large that I just split the screen. So it's like having 2 monitors for me most of the time because it's so huge. It kind of reminds me of when I split my screen, it reminds me of Sarah Martin. If any of you have ever seen what she does, her monitors, normally your monitors are longer or wider, I guess, than they are tall, but she flips hers up on end. So her monitors are very tall and narrow. And so when I split my screen, it's like I have 2 tall, narrow monitors like Sarah Martin. And I mean, who doesn't want to be like Sarah Martin? Come on now.
Sarah Thompson?
Oh, yeah. Sorry. Oh, sorry. So sorry, Sarah, if you accidentally see this. Yeah, Sarah Thompson. Yeah. And she's had her husband for years now. You'd think I would have that together by now. All right. So this is our schedule for the next few weeks. All right.
It appears so. So I guess today is the 16th, the St. Patrick's Day Eve.
It's the what?
St. Patrick's Day Eve.
Oh, yeah. Mm-hmm.
We're going to be talking about how to make sense out of financial statements.
So I'm glad.
Dollars
Robin's going to love that. I'm glad he's here. Okay, and tomorrow we already talked about the Foundation's alumni reunion. I think I did say clearly to wear your St. Patrick's Day swag. You're going to want to have that swag, I promise. So bring it. And then the next day is me, necessity of consistent ongoing training and education. So remember, we are bringing some of our foundations topics to Smart Business Moves, but in a very truncated fashion, and also without the workshop functionality, right? We're going to send you guys back and tell you to do stuff, but we're hoping to be able to give you some good actionable information and give you a sense of what foundations is like. All right. And then next week, we're doing profitability. Yeah.
That's the plan.
Yeah. SEO in plain English, Derek's going to talk about, which is awesome. And Tom, you're doing, what is this? You can't even say it.
PPPE, pay price, productivity, and efficiency. It's a model to maximize profits.
All right. Are you going to be able to do that justice in the limited amount of time that we have?
We're going to go a little bit faster than we did when we went through KPIs for money at the beginning of the year. It'll be, we're doing a big version.
That's not saying much, Tom.
Well, I'm going over, we're doing financial statements today, and
that's true.
So, this will give us the gist. It'll be good.
All right. And then on the 24th, improving recruitment to improve retention. If y'all are like everybody else right now in our industry, you're struggling to recruit and retain team members. So we have some new strategies and some new ideas and some new information to hopefully help and add to what you're currently doing and help you to make some little tweaks there. And then the next week, what are we doing, Tom?
Client management.
I like that Derek says sales is a teachable skill. It is totally a teachable skill. But a lot of times people don't think that. They do think it's a soft skill and you either have it or you don't. So I like that. It's going to be interesting to see what he talks about. Oh, that's one of my favorite topics, Tom. You have to explain it, though.
That's stacking revenue with high frequency recurring revenue?
Mm-hmm. Clients.
Clients, and that's where the revenue comes from. Yeah, it's part of the model that we've been talking about for a while, and it fits right in. The whole idea is it's much easier to scale a house cleaning business off of recurring revenue. So how do you take a lead and not only turn it into a sale, but turn it into a client who wants you to clean their home on some type of recurring basis, and not only a recurring basis, but hopefully at least on an every other week basis. So part of it is the whole process of turning them into a customer and then getting them to use your service on a regular basis and then get them to stay with you to maximize lifetime value. So there's a whole strategy behind that. That's what we're going to be talking about.
So it does sound like it's similar to some of the information from the KPI workshop that we just recently did, but that also sounds like it's got some new stuff in there. Yeah.
Yeah, it's going to be more of the how-to and some of the finer points of, a lot of how you position your company, everything from your website to your marketing material to the expectation you set with a prospect when you're engaging with them, on the phone or however you're communicating with them, can influence what type of client they become. So it's how to everything that message that you're sending, from your branding to your communication strategy, to presume and set the expectation that you're going to want us to clean your home on a regular basis for a long time.
Okay.
You get what you expect to get.
Yeah. Boy, we have really been hammering on this idea of setting expectations over the past, I don't know, at least 6 months. We were really hammering on that expectation piece while we were really hurting with the COVID situation, right? It was critical that the customers know what to expect and the employees know what to expect, which brings us to my topic. Actually, it's my birthday. I just realized that. Okay. On my birthday, I'm going to be talking about controlling your quality standards. That's kind of cool. I I think you guys all know what that means. I don't think I have to go into that, but I do notice that the next day is Tom's birthday, and you guys see that there are no comments there. And that's because the 1st, on Tom's birthday, and also on March 25th, we have sort of surprise things that we're going to be doing. We are still working on some fun things that we can do that will also create value, not just frivolous stuff. So one thing I love, I don't know if you guys love this in your situations, if you guys have anybody that this is good for you. I love having my birthday before Tom's. So I love that. So if Tom celebrates my birthday in a really great way, then, I'm going to outdo him, and I'm going to do even better on his day. And if he does nothing for my birthday, Tom better get a hat. They're pointing, Tom. And if he does nothing, I could still outdo him by just wearing a little hat.
You don't have to try very hard.
You don't have to try very hard. But Tom has my favorite birthday of all time. I was so irritated when I was growing up that my birthday was on March 31st instead of on April Fool's Day. And I think it was wasted on you, Tom. You don't even play April Fool's tricks.
Well, maybe it's kind of shaped me, over the years, I mean, there's a lot of all kinds of jokes and things that go along with having your birthday on April 1st. Oh, yeah. I might be a different person if I was born on March 31st. You just never know how things could have turned out. Maybe
you would be talking to more people and spending more time out and about and visiting. And
yeah, I could be a social butterfly.
Yeah, I'm thinking not so. I'm not thinking so.
Probably not.
No, probably not. All right. Well, we better let you get going, Tom. It's already almost 20 after here.
Is it? Okay. How you like this deck? Doesn't it look good?
Did you guys notice Tom just put this new deck together with the Cleaning Profit Builders on there? I like it. I think it looks good. I'm doing the same thing for mine tomorrow or on Thursday since I like it so much.
So we're going to talk about making sense out of financial statements. So I always say financial statements. What are we talking about? We're talking about 3 different types of documents. The first is the income statement, also known as a profit and loss statement. And anybody who's paid any attention to what we've been doing here since the beginning of the year would know what a income statement or P&L statement is.
All right. So P&L is the same thing as profit and loss, y'all.
Right.
Short version.
It's that document that has the income at the top, subtract the expenses from it, and it gives you profits. And it's a little more complicated than that if you remember from days and weeks past, but we're going to go over that here in just a minute. A second financial statement that is important for your business that doesn't get nearly as much attention in discussions like this, or managing your business from week to week and month to month. I don't think my experience working with a lot of other small businesses, a lot of small cleaning businesses, that it gets a lot of attention is the balance sheet. Mm-hmm. And the balance sheet has a whole nother set of information on it. A balance sheet talks about assets, liabilities, and stockholder equity. So the income statement, in terms of the actual profit from the income statement, flows up and shows on the balance sheet. But the balance sheet has a whole nother set of uses that are very important to growing a successful and building value over the long run in your business. And we'll drill in that here in a minute as well. And the third financial statement that you'll need to know, or you should know, and is useful to you, we're going to share some here, is a cash flow statement or statement of cash flows. And this is basically just talking about cash, the actual hard money you have available to you. And it's the cash that you have to pay debt, expenses, and fund investments. And it basically shows you the cash that you have at the beginning of the month and the cash that you would have at the end of the month. And what you have at the end of the month basically is what you have at the beginning of the next month. And you use it to make sure that you've got enough money on hand to do the things that you need to do and want to do with inside of your business. So an income statement and a statement of cash flows is over a period of time. A balance sheet is a snapshot where it's just at this point in time, and you can pick whatever period of time you want, but it doesn't cover a period. Rather, it's at that instant that you run the report. It shows you your assets, liabilities, and equity. And whenever you hear a company talk about generically, or your accountant or whatever, your financial statements, it's basically a combination of these three documents. A lot of times your CPA might not do a cash flow statement for you. At the very least, though, you want to make sure that you have a relevant income statement and balance sheet. And we'll talk about that here in a minute.
I'm sure a lot of you are like me, and the balance sheet is just confusing as heck. It's like, I have to have the balance sheet explained to me, or I have had to have the balance sheet explained to me multiple times. What happens to me with the balance sheet is I learn about it. I learn how to use it. I understand it. I'm like, oh, okay. It's so good. It makes perfect sense. I get it. Talk to me about it in 3 months. And I'm like, yeah, balance sheet? What is, how again? So I mean, I've sat through classes with you, Tom, and I've watched you explain it. I love it when you do. I always get it. But even right now, I feel fuzzy on the balance sheet. So I'm super excited to hear again.
It's not a natural thought process.
It's not.
And you after you play with it for a little bit, it starts to click. And what I want to show you is how these three documents kind of relate together. And like if you look at a balance sheet, it's like, well, where do those numbers come from? I'm going to try to show you that to some degree anyway, in terms of how all those numbers come together. But let's get some of the easy stuff out of the way. We all know what the profit and loss statement or the income statement is because of what we've been doing in weeks past, where you've got the revenue, that's the money your clients pay you. You've got your cost of goods sold, which is the variable cost providing your service. There's an acronym that we've used a lot to describe that. Your loaded direct payroll to revenue, LDPR, right? That's the percentage that we use to determine that. It's a good proxy. It's a very good proxy for cost of goods sold, much easier to calculate. Gross profit, that's the amount of money that's left over after you pay your cost of goods sold, or in our case, for the most part, our loaded direct payroll. And out of our gross profit, we pay our operating expenses, which are the fixed costs, and what's left over is our net profit. So net profit, gross profit minus operating expenses. I feel like we've done that so much. If there's anybody here that wants us to drill in that, we can.
No, we can't. I'm going to send you back in time to the last 3
Go
weeks.
back and there's some videos that you can watch. There's
a lot of them, and you can get really in depth on it. So I want to be able to get through the foundation stuff.
One thing I want to point out on the P&L, profit and loss statement, that I see I see this a lot. More than 50% of the time when I'm looking at somebody's P&L, what I see is revenue at the top, all their expenses lumped together, and profit at the bottom. And their direct payroll is mixed in with their office payroll, and it's all showing up as expense. And we're not separating the variable cost from the fixed cost. And when you do that, go ahead.
I do want to say real quick. So Tom's talking about this. Remember, we're talking about foundations. So one of the things that happens at foundations is that everybody brings their QuickBooks information, so that some of the stuff that Tom is telling you about, this is when we talk about the workshops, this is one of the things that has to get fixed, right? We have to be fixing some of this stuff. The reason why he's saying he sees this all the time is people at foundations bring their QuickBooks with them. So I just want to tell you that, because some people I know are talking about coming to foundations, and that's a scary piece. Yep, You got to bring your QuickBooks.
We'll help you with us.
Oh, yeah. When you leave, you'll be like, hallelujah. I think more tears are shed in this part of the program than any other program, because people are just like, I never thought I could get it. So I love that.
So you don't want that. If that's the way your P&L looks, that doesn't have a whole lot of value to you. I don't want to say it's completely useless, but there's not a whole lot you can do with it. You can make much better decisions and make a whole lot more money, be a lot more profitable if you have your revenue, and then below that, you take all of your cost of goods sold, which is basically your variable expenses, your direct labor costs and associated costs. And in QuickBooks, actually, you don't code those as expenses. You tell QuickBooks that those things are cost of goods sold, and it separates them differently on the P&L. So it'll subtract cost of goods sold from revenue, and you'll get a gross profit. And from there, you subtract your operating expense to get your net profit. And once you do that, you can do calculations to figure out what is my break-even point. You can do calculations to figure out if I can be just a little bit more productive and get my cost of goods sold to revenue down by 1%, how much more profit I'll be making. You can coach your teams and the people doing your scheduling and look at what rate increases do for you. I could spend the rest of our hour here just talking about all the wonderful things you can do if your P&L looks like that. Whereas if it looks like what it looks like under the X, you can't do anything with it. So said simply, it would look like this with the revenue, cost of goods sold, gross profit, operating expense, net profit. You guys know this. We've done this week over week after week. This is just another picture of the same thing. You guys are all over this. So this is kind of an example. $100,000 in revenue. Direct labor is the biggest part of cost of goods sold, but there's some other things here. You got some insurance and throwing a little bit in for like reimbursing people for mileage and so forth, and a little bit for cleaning supplies. Total cost of goods sold 55%. So 100,000 subtract 55,000 for cost of goods sold. That gives you a gross profit of $45,000. So from there, you separate black out your other expenses, get total operating expenses of 30,000. 30 from 45 gives you 15,000, or 15% pre-tax profit on $100,000. Benchmarks for each one of these, cost of goods sold can be anywhere from 40 to 60%, operating expenses 30 to 40, and this can vary a lot depending on your business model, as we've discussed in weeks past. Income 10, 20. I've seen people 25, even flirting with 30% in some cases when all the stars line up well.
And we're talking about employees here, pretty much, because the numbers can look different when you've got independent contractors.
Yes, this is built on a employee-based model. So if I've got operating expense of $30,000, and if I know that 45 cents out of every dollar that I generate is going to be flowing down to cover these expenses and profit, I can take that 30,000 and divide it by 0.45 and come up with a number, and that's my break-even point. And I don't know what that is if I don't have my variable and operating expenses broke out separately. And we did that here in weeks past somewhere. This rate increase break even. Oh, heck with it. I'll just do it again. So
there it is. Rate increase, break even. I see it.
That's the rate increase. That's the rate increase.
Oh, to your left, 2. One more. There you go.
Yeah, that was a different calculation, though. That was how many customers you could lose after a rate increase and still break even. But if I know that I'll blow this up. If I know my operating expense is 30,000, And if I know that my if my gross profit percentage is 45%, and with that, if it's my gross profit percentage is 45%, that means my cost of goods sold to revenue is 55%. Does that make sense? So if I take the my break-even revenue is 30,000 divided by 45%, or $66,666.70. So at the beginning of the month, I'm gonna say, am I making money? Am I not making money? Well, it depends what your revenue is, right? And if I know that my cost of goods sold is always a percentage, that expense is always going to be a percentage of my revenue. And if I know that $30,000 is my operating expense, the fixed amount, then I know that I got to get at least 66,670 cents to break even. And after that, 45 cents out of every dollar is going in my pocket. Can't do that unless your P&L looks like this, though. So you really
have no way of knowing what those numbers are, no way of figuring out. Or
you can't do anything with it. If your P&L is all lumped up where your variable and fixed expenses are together and all treated as expenses, you just can't do anything with it.
It's not a tool at that point. Then it's just information, and you can't use it as a tool. So, and that's kind of the point here, is that these financial statements are tools to help you improve your business and to be your most profitable. So don't create situations where your tools are broken. So
we said our revenue in the example was $100,000 for that month, right? Mm-hmm. So we would know that if that was our break-even revenue, then I take 100,000 and subtract my break-even revenue from it. I got $33,000 that has potential going to profit, and 45% of that is going to profit. So if I take that amount, do this, times 0.45, that comes out to be $15,000 in profit. And that's what we said down here. Make sense?
Yep. Makes sense.
Okay. So why?
Questions? I know we're not on Zoom, so it's hard to ask questions, but does anybody have any questions? And normally this would be more interactive. At Foundations, it's more interactive because everybody has their P&L up on the screen while Tom is teaching, and he's asking questions about, so what's your direct labor, and trying to figure out how we can work with whatever is being seen. And a lot of times, like Tom said, more than half the time, everything's all lumped together. So the first step is, let's get everything separated out and get the P&L structured the correct way.
But if you've got like a bookkeeper or a CPA or somebody helping you with this, what you want to do is go to them and say, I would like to have my cost of goods sold separated from my operating expenses so it looks like this. It looks like this.
Take a screen share.
And we sent this out.
Yes, Linda, absolutely. You can. And that's the recommendation.
Yeah, this is not hard to do in QuickBooks. You can take all your variable costs and code them as cost of goods sold, because a lot of times everything just says it's an expense. So you want to change the account type from expense to cost of goods sold. It'll separate out. It'll magic.
Yeah.
So pretty obvious why a P&L could be a pretty useful tool if you set it up the right way, right?
Yeah. This is my favorite. I love the P&L. I feel like it's super useful.
You know, if I was
I'm not even a money person like you are, Tom. I feel like the P&L is super awesome because even for people like me, it's so clear and it gives such good information that's really usable. And you don't have to be the smartest person in the room. I mean, a lot of times people are like, well, Tom's so smart. Of course, this stuff is easy for him. But you don't have to be the smartest person in the room. I mean, I get it, right? I can use this. This is awesome. And it's so helpful. All you have to do is be able to understand it. And then it, again, becomes a really good tool. So yeah, I love the P&L.
Play around with QuickBooks a little bit. Do yourself a favor without any real, deliverable objective other than I'm just going to play around and see what I can do with it. Go to reports, pull up I think they call it the income statement. They might call it P&L. I don't remember. I think it's the same report, whatever they call it in QuickBooks. There's all kinds of filters at the top that you can play with in terms of picking what time frame you want to run the report. And you can also pick what periods you want it to present the information. You can it'll present a total. So if you want to say, I want to look at my P&L for the last 12 months and give me a total, it'll just give you one set of numbers. Or you can say, I want to see it over by quarter. So it'll break out your first quarter from second quarter to third quarter to fourth quarter to see how the numbers are changing quarter to quarter. It'll let you do it by month. So you can change it by, see how it's changing by month. It'll let you do it by week. Play with that. And then it's got filters where it'll do percentages. It'll do variances too. Like if you're doing like months and you want to say, I want to see the variance month over month, it will show you what that number changed month over month. It'll do variance, will show you how that number has changed from that same month the year prior. Or it'll do percentages. We'll show you what all the numbers are as a percent to revenue, for instance. Just play with it. And you'll see things and you'll start asking questions. Well, gee, that must be there for a reason. How do people use that? And ask your accountant, ask your CPA, ask us. We'll be glad to help you. But it's a wealth of information and what you can do with this, especially if you're playing with it in QuickBooks.
And also, Tom's talking about play with your QuickBooks. And for a lot of people out there, that's like, yeah, I'm never doing that. I'm afraid to mess something up or to ruin things. He's not saying just go in there willy-nilly. What he's saying is go into the reports section and run reports. Any report, you can't mess anything up by running a report. Nothing gets impacted. You could run reports all day, every single report you could ever think of, and it can't mess up anything. So that's what he's talking about. Go in, run every kind of report you can think of, or any report that you're like, what the heck is that? Why would I even care? Run the report, look at it, try to figure it out. And the reason why he wants you to do this, look at it, try to figure it out on your own, is when you do that, you're going to understand it so much better. You doing it, well, I'm going to use my snowboard analogy again, right? I can watch all the videos on snowboarding. I can watch Tom snowboard. I can watch Leslie snowboard. But until I pop the board on my shoes and jump up on the mountain, I don't know how to snowboard. And I'm never going to understand truly what it's like to snowboard until I get snapped into my board and get on the mountain. So that's what the reports is. Snap in and take a whirl. Run all the reports you can think of. How many people, Tom, have we worked with that the number one thing they don't want to talk about, they don't want to deal with, they're afraid of is QuickBooks. And then after foundations, they're like, I love my numbers now. I love doing it.
It creates anxiety. It's I don't know if the piece of software QuickBooks, it's what it represents. It's the financial shape of my business. Do I have money or not? Am I making money or am I going broke? It's it's like, I don't want to go to the doctor because I might be sick and I don't want to be told I'm sick. And it's like, you are what you are, and you need to figure out what you are so you can become what you want to be.
Yeah, because there's medication for almost every kind of sickness.
whatever problem QuickBooks tells you have, there's a solution for it.
Yeah.
And the sooner you can identify the problem, the sooner we can start taking the medicine to make it better.
Because if you don't do it, I mean, taking it just one step further, if you don't go to the doctor, sometimes you let things go too long until they can't be fixed. So don't wait. Just jump on in there and check it out. Because right now, that's the perfect time. We've got the answers. We got the medicine for you.
So we're going to move along here. Another version of a P&L, and this is kind of a different perspective. This is a little more complicated, but still the same thing. You got your income, you got your cost of goods sold, you got your gross profit here, you got operating expenses, you got all your operating expenses added up, you subtract your operating expenses from your gross profit, it gives you your net income or your net profit. Your income minus your cost of goods sold is your gross profit. So that's what we're showing here, that I've got income of 34, almost 35,000. I've got cost of goods sold of 15. I take the 35, subtract the 15, it gives me almost 20. See, I'm just rounding numbers off in my head. I can't do the math to the penny, but this is almost 35,000. That's almost 15,000. 35 minus 15, this is almost 20,000. Make sense?
Does.
Gross profit minus operating expenses, net profit. So I got 20,000 minus 11,500. That leaves me about 8,500 here.
And so remember, Tom was talking about those reports. This is a report that you could look at. You see how on the right-hand side, have you ever wondered, how do people know what percentage they're spending on office supplies? How do people know that? This is how they know that. It's just on a report. They don't have to do anything special. They just say, this is the report that I want to look at, and then they can see how much do you spend on breakage and damage. Oh, look, that's on here. I mean, you have to be tracking the things that you want to look at, but you could, if that's something that you're like, we break a lot of things in our company. I don't know. I need to be tracking that. You could.
And in QuickBooks, if you want to know what these numbers are as a percent to income, there's a filter. You can just click on it and it'll do this for you in the report for the P&L. So you don't have to do these calculations yourself. QuickBooks will do it for you. Let's talk about a balance sheet. Balance sheet, completely separate report. The P&L is where we start. It's the most, I believe it's the most important report as operators of cleaning businesses. If I'm stuck on a desert island and I can only have one financial statement, I would want it to be the P&L.
Yeah.
But a balance sheet is something that you should look at from time to time. You should talk to your CPA. There's some things on it that are important that you need to know and understand. It's a snapshot in time of your company's assets, liabilities, and owner's equity.
So Tom keeps mentioning the snapshot in time, you guys. Tom, can you explain why that's important? Because it's a really big deal about the balance sheet. You never hear him say that about the P&L. You don't hear him say that about the cash flow. You only hear him say that about the balance sheet.
If I run a P&L for last year and compare it to the P&L for December of last year, the numbers for the entire year are going to be a whole lot bigger because I'm adding up income and expenses and profit for an entire year as opposed to just a month. Okay?
Yeah.
So for a period of time. Mm-hmm. A balance sheet is a snapshot. It's like you don't add your assets up. It's kind of like, think of a balance sheet as your weight. So I weigh myself every day. And that's a snapshot in time. It really isn't relevant for me to take my weight every day and add it up and say my total weight for the month of March it was some really big number, but it really doesn't matter. What matters is what I weigh at that instant in time.
Well, does the average matter? Because I might want to know what the average is of my weight over the course of a month or a year. Would that matter with the balance sheet?
You can do that, and you can run your balance sheet for various snapshots in time. Because really, you weigh yourself every day. Each one of those is an individual snapshot in time, and you can average those. You can take variance, and we do this. I've got an example where you look at your balance sheet at the end of, December and compare it to your balance sheet for at the end of January to see how some things changed. What you don't do is take the numbers off your balance sheet for 12 months and add them together and say, well, this is my balance sheet for the year. What you can say is my balance sheet looked like this at the beginning of the year or the end of the year or the middle of the year.
Yeah.
So
okay, I love that. I love
P&L, you add the numbers together, and if you do it for 2 years, the numbers are going to be bigger than if it's 1 year. But a balance sheet is just stepping on the scale at that instant.
Yeah, it's great. That scale analogy is really good. Really, really easy to understand.
So assets, those are the items that your company owns that can provide future economic growth. An asset, one of your biggest, assets is cash. Well, how much money do you have in your checking account? Vehicles, or if you buy your vehicles, they would be considered assets. Certain pieces of equipment. If you buy a piece of equipment with the expectation that's going to last longer than 12 months, that would be treated as an asset. Computer equipment, stuff like that. Liability is money you owe. So if I buy a car that has a value of $20,000 and I pay $5,000 down, then theoretically I've got a liability of $15,000. I might be financing the rest of it over 5 years. The equity that I have in that car would be $5,000 less depreciation because it really isn't worth $20,000 anymore. But so the assets are the things that you own. The liability is the money that you owe. And you take the difference between the two, and that is owner equity. That is the real value in your business. And that doesn't mean what your sales price is. If you were selling your business, that's a completely different calculation. But what you can do is look at your balance sheet over various snapshots in time. And if that owner equity keeps going up, that's telling you that you are acquiring more assets or getting rid of liability, and you're creating more value in your business. If you keep doing that over the long run, you're going to have a more valuable business, and you're going to be a wealthier person, wealthier business owner. This is what a balance sheet looks like. And you've got your assets at the top, and all of these things here are various types of assets. You can see all your bank accounts is an asset. You see we've got two columns here. One is December 17, and the other is January 18. And these are run at the end of the month, typically. So the end of December, these were the numbers. Into January, these are the numbers. And guess what? The end of December is the same as the beginning of January for these purposes. So basically, the difference between these two columns is what happened over the month of January. Same as, I weigh myself at the end of December, I weigh myself at the end of January, I take the difference. That's how much weight I gained or lost over the month of January.
That's January, duh, we gained.
No, you lose it over in January. You gained it in December. You're dieting, New Year.
New Year's, right? The New Year's.
Yeah. So a couple of things to look at here. Assets are cash. Assets could be considered accounts receivable. That's money people owe you. You claimed and you bill them, and they're going to, pay you, next week, next month, or whatever. Got this thing called undeposited funds. That's important. That's money that's been paid to you, but it's in the form of a check or a credit card that's being processed, and the money's not in the bank yet. You don't want to say it's in the bank, but it's there, it's coming, so you treat that as an asset. You take these two green numbers and you add them together, that is your total cash. And this shows up on your cash flow statement. I'll show you that in just a second. From a cash standpoint, well, let me do this. So I got my assets up here, I got my liabilities down here, and this is money you owe. Current liabilities are monies that you owe within the next 12 months. Long-term liabilities are monies you owe over a longer period of time. So things like car notes, if you got if you own any property, a building or something that you're paying off over a long period of time, all those are considered long-term liabilities. So I've got assets of 140, liabilities of 158. Remember, assets minus liabilities is total equity. Got a negative equity of $18,000 almost, 17.6. That's not unusual because, a lot of times small businesses wind up, borrowing money to get things going and making investments. And, you can get to the point where you've got negative equity. That's not necessarily a terrible thing. What you want to see, though, is that negative number getting to be a smaller negative number over time. If you notice that in January, that negative 17 goes down to negative 9. So that's a good thing. And you can see it's a good thing over here on the third statement that I want to show you. Is the statement of cash flows. Operating at, and basically you add all these numbers up together, and that basically tells you how much cash you're generating for the period. And if your cash is going up over the period, and you can see that down at the bottom here, where at the beginning of the period you had $18,000 in cash, and at the end of the period you had $17,000 in cash. You basically spent $1,000 more in cash than you actually collected. Doesn't mean that you were losing money. You were making money, because all these are tying together here. If I go back to my P&L, I made $8,400. As you can see here, net income, $8,400. So my P&L said I was making money, but my accounts receivable went up by $5,000. You see, I got a negative $5,400. I go to my balance sheet and I look at my accounts receivable. It was, people owed me $2,800 at the beginning of January. They owed me $8,200 at the end of January. So something happened, and people owe this company $6,000, or not quite $6,000, $5,400 more at the end of January than the beginning of January. Does that make sense?
Yep, sure does.
These colors are kind of tying it together here. These two green numbers together give you the cash at the beginning of the period, if you remember. The difference between the long-term liabilities here basically give you the cash it takes to cover your financing activities. That's basically the principal you're paying on your car notes and stuff like that. You add all these numbers together here, and it gives you this number of negative $170 basically. So 170, negative 170 minus negative 9. So basically this company is breaking even for the most part. It lost $170 out of operating whatever when it was covering, didn't really lose it, but when it was, subsidizing the accounts receivable and some of the other things up here, but then it had to pay the principal on some long-term notes, and it wound up spending $1,100 more in cash than it actually had. So
hey, how many people are following this statement of cash flows? And how many people are thinking, I might need a little bit more information here? Yeah. We don't have a ton of information, so if you need more, don't worry. That we have ways of getting more information to you, but if you need more, let us know. Tom, I know we're kind of tight on time, but one thing that I know messes with people a lot is, why is the total assets, why does that equal the total liabilities and equity? I think for a lot of people that's confusing, because when you're looking at your P&L, the number at the bottom is like the answer, but that's not how a balance sheet works.
Well, in the simplest form, pretend you're buying a car and that's the only asset you have.
Okay.
And you pay $5,000 down. It's a $20,000 car. You give a $5,000 down payment, and you're financing the other $15,000.
Okay.
So the asset is $20,000. The car is the entire value of the car, and it's your car, and it's worth $20,000.
Yeah.
You own 5,000 of it, and that is the equity, if you will, the owner equity, and the bank owns 15,000 of it. That's the liability.
Right. But it feels like my car.
Well, it is. It's your car, and you and the bank own it together. You own 5,000 of it. The bank owns 15,000.
Yeah. All right. And so that's why these numbers match, because the numbers altogether still have to add up on both sides.
So ideally, you want to see your, working your liabilities down. You want to see, your assets going up. You want to see your, equity improving month over month. There's exceptions to that. Strategically, you might be making investments in your business that are going to, return, give you bigger returns in the future. But the balance sheet is important to understand how these numbers work and how they tie into the statement of cash flows. And this is really important. If you constantly see month over month that the ending number is less than the beginning number, that's telling you that one day you're not going to have any cash left. And you got to figure out, what do I need to do next month to make sure the ending number is bigger than the beginning number? And in this case, I would say, well, gee whiz, what are the big negative numbers up here? It's in accounts receivable. I need to pick up the phone, make some phone calls, and get some people who owe me money to pay me. So next month, this number is bigger than what it was at the beginning of the month.
So when you are selling your business or buying a business, but for most people, they're thinking about when they're selling their business, it's important to have these, you're going to have to provide all of these financial documents. And so it's important that these numbers look the way you want them to look for the potential buyer, because if they see that number keeps getting smaller and smaller, they also don't see this as a strong company. And if they see that the equity is not getting bigger, you're not getting more equity, then they need to know why. Were you investing? What were you doing? Why? Where's that? So it's important that you look at all of these so that you know what your position is, not just for yourself, but also to the bank, to other potential investors, and also for yourself, so that you know how to move forward.
This is why you do this. It's not about how many homes you clean. It's about building value in your business. It's about building profitable businesses. And it's through, understanding, having a P&L that's structured properly, and understanding what your balance sheet is telling you. And are you growing equity? And is your cash flow healthy? Is your cash flow at least staying constant? You're not, losing cash month over month. Those are important to know. We're at the top of the hour. Tomorrow is the St. Patrick's Day alumni reunion.
Yeah.
We're going to be doing Zoom. It's going to be crazy. We're going to have green beer.
Of course, bring your green beer. Absolutely. That might count in your favor.
I might start early.
Yeah, good time.
I
like when you have a little beer or two. You're even funnier.
Okay. We'll see you guys tomorrow at 5 o'clock. Bye-bye.
Bye, y'all.